Richard, very good morning to you. I'm going to start with the U.S. markets and how they've responded to John Williams, the New York Federal Reserve President Chief's comments on rate cuts. Do you think that's the big driver, even as at least some of those AI overvaluation fears seem to have eased?
Well, it is a driver. Basically, rates go down, stock market gets happier. It's as simple as the equation as that. I think there's no doubt that there is a bias for rates coming down. Yes, the Fed has been holding off because, many of the indicators we look at, such as unemployment, such as economic growth, have been stubbornly strong, especially as most analysts thought that post-tariffs we may see things coming back. But the financial system is very robust. It's very strong. Bull markets die hard. So generally, people have kept on going as if there's no tomorrow. But we're seeing consumer confidence figures that are really quite low. So there does seem to be some concern in the wings. And the question the Fed is, I guess, asking itself is do they wait for absolute confirmation from many sources of data that the US economy is slowing? Or is there an indication that maybe they should act slightly earlier? They're really only talking about small cuts, 25 basis points. But I think that's where the bias is. And I think the market will like that kind of news.
Okay, Richard, good morning. Hiral on this side. So are you saying that majority of the chance is of a 25 basis point rate cut right now? And if that happens, what's the kind of direct impact that you're seeing in terms of US markets and in turn global markets as well?
I would be surprised if they cut immediately. Don't forget, they've recently had a meeting where they said that they were probably not going to cut. So if they cut now, that would be a sign of desperation. But certainly, when you're looking into the early parts of the new year, that's eminently feasible. Markets like interest rates coming down. It's probably the last round in the arsenal that the authorities have, because, of course, Trump has increased spending so much. There's likely to be a big hangover for that, and that spending often goes into the markets. We've got money coming into the Treasury, so people are being hit the other way. But certainly, I think that if the market does see interest rates coming through, they will take that quite positively. And by positively, I mean the market is unlikely to go down immediately, even though it looks very fragile at the moment.
Okay, Richard, in terms of tariffs and the smoke signals we're seeing from Trump administration coming in, another set of tariffs have come down. And obviously, it depends on what pinches the U.S. consumer. Does that give good signs for a potential India-U.S. trade deal? Because that's the one that's been truly delayed.
It has been delayed. I'm not entirely sure of the reason why, and it probably doesn't matter. These things have to be negotiated much more in a linear fashion. It's very difficult to negotiate them together because, of course, Trump's got the final say on everything. But we have seen Switzerland come down from 35% to 15%. I don't think the Swiss have any particular strong leverage that India doesn't have. And I think India probably does have quite a lot of leverage. The Modi-Trump relationship does and has always seemed to be quite strong. It was a surprise that those tariffs went up. And of course, they went up almost on a political basis over the import of oil as opposed to anything else. I think that if both sides relax their positions just a little bit, we are likely to see a deal much more like Switzerland of the 15% than the tariffs we are seeing at the moment.
Interesting. So that's with regards to tariffs, Richard. How are you looking at emerging markets? Because right now, a lot of chatter when it comes about the yen carry trade nervousness that's gripping world markets. You're talking about the benchmark bond yields that have risen to a 17-year high. How are you seeing this impact emerging markets? Because you would start seeing outflows from there then.
Well, I think it's important to distinguish, say, India from emerging markets, China from emerging markets. Quite frankly, they're not emerging anymore. They're way on the way to the developed market status. India's middle class is bigger than most countries. So it's difficult really to put them in the same bucket. My feeling is that if you're looking at frontier or emerging markets, if the markets do bad, they will tend not to do particularly well. But India, of course, has a huge industrial base that it can rely on, as indeed does China. And China's got this very advancing technological base as well, which is beginning to be quite leading edge because of the issue with getting leading edge electronic equipment from elsewhere. So I think you need to put them in a different category. I'm a great believer of, what goes up must come down, and what doesn't go up doesn't go down quite so much. So if we did have a real crisis in the markets now, I think India may be relatively robust. I think China may be relatively robust. They may not reduce or be able to resist a big downfall, but I think they will be more robust than other markets. But that's very different for real emerging markets, which could get hit quite hard.
Okay, so the important point over here is to distinguish India from China when it comes to emerging markets, Richard, and that's an interesting way to look at it as well. But thank you so much for joining us on NDTV Profit. Always a pleasure to speak to you as well.